I want you to just picture this for a second. Imagine a janitor, right?
Yeah.
Just a regular guy making maybe $50,000 a year.
Okay. Yeah. Normal salary.
Right. And he dies with $8 million in the bank.
Oh, wow. Wait, 8 million?
$8 million. And on that exact same day, a former Merrill Lynch executive making like $500,000 a year files for bankruptcy.
That is wild.
Right, because standard math says this scenario is totally impossible. But human psychology says it literally happens every single day.
Yeah, it completely shatters everything we're taught about how success works, doesn't it?
Oh, total.
Like, we just assume that a 10 times higher income must automatically guarantee, at least 10 times the financial security.
I mean, that's what makes logical sense.
Exactly. But the math completely falls apart because we're applying the wrong scientific discipline to the whole problem.
Which is exactly what we are unpacking today. We're doing a deep dive into the core philosophies of Morgan Housel, specifically regarding the psychology of money.
It's such a brilliant framework.
It really is.
Yeah.
The mission today is to completely dismantle this idea that building wealth is about your IQ or your pedigree or, your ability to build some complex spreadsheet.
Right.
We're going to see how it is almost entirely about your emotions and your behavior.
What's fascinating here is that schools literally never teach this.
Never. Not once.
Think about how we're educated. If you take a personal finance class or economics, it's taught as a hard science.
Like physics.
Yeah, exactly, like physics or chemistry. You memorize formulas, you learn about amortization.
Which is really just a super fancy term for how a loan gets paid off.
Exactly, yeah, it's just a schedule. And you calculate compound interest rates.
Right, with the calculators and the charts.
Yeah, the whole educational framework operates on this assumption that if you just give people the right data and the right formulas, they will just naturally make the optimal financial decisions.
Because we're all perfectly rational robots, obviously.
Right. But that fundamentally misunderstands what money actually is in the real world. Like, finance isn't physics.
Right.
Physics is governed by these unbreakable laws of motion. But finance, it's driven by human psychology.
It's messy.
So messy. It's driven by cortisol, by fear, by ego, by greed, and mostly by patience.
It is wild to think about. We spend decades in the education system learning the absolute mechanics of money, but literally 0 hours learning the emotion of money.
Which is the most important part.
Exactly. So if we want to understand how to actually win this game, we first have to understand why the quote-unquote smartest people often completely lose it.
Yeah, those two profiles you mentioned at the very beginning.
The janitor and the executive. And for you listening, these aren't just hypotheticals. These are real people.
Right. Ronald Reed and Richard Fuscone.
Let's get into them.
Their stories are like the ultimate case study in behavior versus intelligence.
Okay, let's unpack this. Tell me about the janitor.
So Ronald Reed was a janitor and a gas station attendant. He spent 25 years fixing cars and then another 17 years just sweeping floors at a JCPenney.
Just a totally blue-collar guy.
Completely. He lived a quiet, incredibly frugal life in Vermont. I mean, he was chopping his own firewood well into his old age.
Wow.
Yeah, and when he died at age 92, he shocked everyone, his family, his friends, his whole community.
Because of the money.
Yeah, because he left behind an $8 million estate.
That is insane.
And he actually left most of it to his local hospital and library.
Okay, let's unpack this a bit more. Because on paper, how does a guy sweeping floors, how does he amass $8 million?
Right.
Did he win the lottery? Did he have some secret trust fund?
No, neither. None of that.
So what did he do?
He just saved what little he could, right. And he invested it in standard blue chip companies. And then, this is the crucial part, he waited.
Just waited.
For decades. He just let the money stir and grow.
Wow.
Now contrast him with the other guy, Richard Fuscone.
The Merrill Lynch guy.
Exactly. So Fuscone had literally everything you would associate with supreme financial intelligence.
The pedigree.
Oh, the highest pedigree. He had a Harvard MBA. He was a wildly successful executive in high finance.
Like top of the food chain.
Right. He was so successful that he actually retired in his 40s to become a philanthropist.
Oh, wow. I didn't know that part.
Yeah, and he borrowed heavily to expand this massive 18,000 square foot mansion in Connecticut.
18,000 square feet. That's ridiculous.
It had 2 elevators, 2 pools, 7 garages, just extreme wealth.
Okay, but then what happened?
Well, then the 2008 financial crisis hit.
Oh.
Yeah.
And his highly educated, heavily leveraged world just completely collapsed.
It vanished. The debt absolutely crushed him. He became illiquid. His properties were foreclosed on, and he filed for bankruptcy.
So the executive with the Harvard MBA loses everything,
Everything.
while the janitor with absolutely no college degree builds this multi-million-dollar empire.
Exactly. Because financial success is not a hard science.
It's a soft skill.
Yes. It is not about knowing more than the next person. It's almost entirely about behaving better than the next person.
You know, treating personal finance like an IQ test is like trying to win a marathon by being the best at math.
Oh, that's a great way to put it.
Like, you might be an absolute genius at trigonometry,
Uh.
right? But if you haven't trained your cardiovascular system, you are going to collapse at mile 3.
You're done.
Exactly.
Mm-hmm.
In this scenario, your cardiovascular system is your emotional regulation. If you can't regulate your emotions, all the math in the world isn't going to save you.
It really won't. Because the true enemy of wealth isn't ignorance. I mean, we live in the information age.
Right, you can just Google anything.
You can pull up real-time stock data, historical PE ratios, complex market analysis right on your phone while you're literally waiting in line for coffee.
So ignorance is basically a choice now.
Largely, yeah. The true enemy is emotion.
Okay, let's dig into that. Which emotions?
Well, think about the market cycle. Fear is the emotion that spikes your heart rate and drives you to panic sell your investments.
At the absolute worst time.
Right at the bottom of a market crash, you watch the screen turn red, your biological fight or flight response kicks in.
And you sell.
And you sell, which permanently locks in your losses.
And then there's the flip side.
Greed. Greed is what drives you to buy at the absolute top of a speculative bubble purely because of FOMO.
The fear of missing out.
Exactly.
Let's talk about ego, too, because I think this is the one that trips up everyone, regardless of their tax bracket.
Oh, ego is huge.
Ego drives us to spend money we do not have, to buy things we don't even really want, just to impress people we don't even like.
It's so true.
Like the pressure to upgrade the car or get that designer jacket or lease some luxury SUV just to signal status to a stranger in traffic.
Yeah.
Or like a coworker we secretly despise.
It is a remarkably common biological trap.
Biological.
Yeah, we're literally wired as a species to signal status,
Right.
and having a high IQ does not protect you from those biological urges.
That makes a lot of sense.
In fact, a high IQ can actually be a massive liability in finance if it's paired with overconfidence.
Wait, really? How does being smart make you worse at this?
Well, highly intelligent people are used to being the smartest person in the room, right?
Sure.
So they start to believe their intellect allows them to predict complex systems, like the global economy.
Which is impossible.
Exactly. The market isn't a spreadsheet. It's a living organism made up of millions of completely irrational humans.
Right.
So when the market does something completely irrational, that highly intelligent person can panic because the model they built in their head just broke.
They assume the market is wrong, not them.
Exactly. And they double down or they panic because they lack the emotional flexibility to just admit they don't know what's going to happen next.
So the smartest investor is not the one with the highest IQ.
Not at all. It's the one who stays calm when everyone else is completely losing their minds.
But there's a really compassionate, almost relieving point to be made here from the source material.
But the idea that no one is crazy.
Yes. This concept that no one is crazy. When we see someone making what looks to us like a terrible, totally irrational financial decision, our first instinct is just pure judgment.
Oh, absolutely. We love to judge.
We look at someone hoarding cash under a mattress or someone else YOLOing their life savings into some volatile meme stock, and we just think, what an idiot.
But the empathy required in finance is vastly underrated.
Yeah.
Financial decisions are deeply personal. They are formed by the very specific economic environments we experience in our formative years.
Okay, let's ground this in reality for a second. Let's put ourselves in the shoes of someone who grew up in the late 1970s and early 1980s.
That is a perfect era to look at.
Right.
If you came of age then, you experienced massive runaway inflation.
Like double-digit inflation.
Yeah. You watched the cost of everyday goods literally double. You watched your parents' purchasing power get utterly destroyed.
So your whole worldview of money is based on that trauma.
Exactly. Your fundamental understanding of how money works was shaked. by the trauma of inflation. Now, compare that to someone born 20 years later.
Okay, someone who came of age during the booming tech market of the 1990s.
Right. The 90s kid.
They only saw stocks go up. They saw rapid expansion, huge job growth, a seemingly invincible economy.
So if you take those two people today, right now, and you offer them the exact same investment portfolio,
They're going to react in wildly different ways.
wildly different. To the person raised in the 90s boom, putting their savings into the stock market seems like a logical, safe, very simple step.
It's a no-brainer for them.
But to the person who watched their family get crushed by 70s inflation,
Or worse, someone who grew up in extreme poverty and watched their parents lose their house.
exactly. To them, that exact same action feels like existential terror.
They will naturally fear investing.
And they aren't crazy for feeling that way.
Right, they are making a completely rational decision based on the data their own life has provided them.
Precisely. Your financial decisions are not random. They're deeply personal.
Which explains exactly why comparing yourself to others is so incredibly dangerous.
You just don't know their story.
You don't know the invisible emotional baggage they're carrying or, the safety nets they might have hidden away. And they don't know yours.
We are all playing completely different games based on the rule books our distinct lives just handed us.
This has profound implications for you listening to this right now. Like, if behavior truly matters more than intelligence,
Like it does.
if your emotional regulation matters more than your pedigree, then the playing field of wealth is radically leveled.
It democratizes the entire concept of getting wealthy.
It really does. You don't need a degree from Wharton. You just need to cultivate patience. You need to manage your ego.
Anyone, regardless of their academic background, can practice staying calm.
It takes the power away from the institutional gatekeepers and puts it directly into your own hand.
But we have to make a really crucial distinction here.
Okay, what's that?
Because the behaviors that help you acquire wealth in the first place are completely different from the behaviors required to keep it. You literally have to change your personality once the money is in the bank.
This brings us perfectly to the two completely different games of wealth. Getting rich versus staying rich.
They are totally opposing mindsets.
Making money and keeping money. Let's talk about getting rich first.
Getting rich requires audacity.
Audacity. I like that.
It requires taking risks, stepping out into the unknown, building businesses, trying new investments, really swinging for the fences.
You have to be deeply optimistic.
Oh, you have to be. You have to believe that despite all the odds, things are going to work out in your favor.
You have to be a little bit delusional in your self-belief to start a company from scratch.
You really do. But staying rich requires the exact opposite.
Which is what?
It requires paranoia.
Paranoia. Wow.
It requires humility, discipline, and a highly defensive posture.
Because you have something to lose now.
Exactly. It requires the constant, sobering acknowledgement that whatever you've built could be taken away by a shift in the market or a global pandemic or a new competitor.
This explains so much of pop culture history.
Doesn't it?
We constantly see headlines about lottery winners
Yeah.
or massive pro athletes signing $80 million contracts.
Or incredibly successful entrepreneurs who sell their tech startup.
Right. And then 5 years later, they are completely broke. We look at them and think, how on earth did you blow $100 million?
It's because they kept playing the getting rich game. They kept taking huge risks, being overly optimistic, spending aggressively.
When they should have transitioned to the staying rich game.
Exactly. A phenomenal historical example of this is Jesse Livermore.
Okay, tell me about Jesse.
He was one of the greatest stock market traders of the early 20th century.
Okay.
During the 1929 stock market crash, the crash that kicked off the Great Depression and ruined literally millions of families, Livermore actually saw it coming.
Wait, he predicted the 1929 crash.
He did. He shorted the market, betting that it would fall.
Oh, wow.
And in a single week in 1929, while the whole world was basically jumping out of windows, he made the equivalent of over $1 billion in today's money.
$1 billion in a week.
In a week.
So he beat the system. He won the ultimate getting rich game.
He absolutely did. But look at what happened next.
What happened?
That massive success filled him with absolute overconfidence. He felt totally invincible.
He lost his humility.
He lost all of it. Over the next 4 years, he continued to take massive, highly leveraged bets on the market, assuming he could always just outsmart it.
Oh, no.
Yeah. By 1933, he had lost every single penny of that billion-dollar fortune.
Every penny.
He couldn't transition from the optimism of getting rich to the paranoia of staying rich.
Wealth isn't an event, is it? We're so conditioned by movies to think of wealth as the climax of the story.
Right, like the big IPO or the lottery ticket or the massive inheritance.
But wealth is actually thousands and thousands of small, boring daily decisions that happen after the big event.
Exactly. Many people can figure out how to make a large sum of money.
But very, very few possess the psychological discipline to protect it.
And part of protecting it relies on really understanding what wealth actually looks like.
Because our society has a fundamentally flawed visual definition of success.
Completely flawed. True wealth is actually invisible.
Okay, let's do a thought experiment to picture this. Imagine a busy intersection in a high-end neighborhood.
Okay, I'm picturing it.
At the red light, you have two cars sitting side by side.
Right.
One is a brand new neon green Lamborghini. The other is a 10-year-old, completely standard, mildly dented Toyota Camry.
Okay.
If I walk down the sidewalk and ask anyone, literally anyone, who is the wealthy person here, 100% of people will point to the Lamborghini.
Of course they will. We rely on visual cues to assess status. It's a cognitive shortcut for our brains.
But appearances are entirely deceptive. Being rich means spending money. Being wealthy means not spending it.
That is such an important distinction.
The Lamborghini driver is choosing to be rich in the moment, visibly.
While the Toyota driver, who might have $3 million quietly compounding in index funds, is choosing to be wealthy invisibly. If we connect this to the bigger picture, we have to distinctly separate those words, rich and wealthy.
Even though we use them interchangeably all the time.
Right. In casual conversation, they mean the same thing. But psychologically, they are worlds apart.
How so?
Rich is a current state of income and spending. When you see someone driving a $300,000 Lamborghini, all you actually know about their finances is that they have $300,000 less than they did before they bought the car.
Or they're heavily in debt.
Far more likely, yeah. They are tied to a crippling, high-interest monthly lease payment.
So the richest-looking person in the room might actually be drowning in debt.
Exactly. Living paycheck to paycheck on a massive, highly stressful scale.
Okay, but let me push back on this a little bit. Let's be real about this invisible wealth thing.
Okay, go for it.
We are biologically wired to signal status. Millions of years of evolution have taught us that displaying resources attracts mates, secures social standing, ensures survival.
It's why peacocks have giant, bright feathers.
Right. Even though it makes them easier for predators to catch, the feathers say, look how strong I am.
Yeah.
So you're asking people to fight their own biology. Isn't the entire cultural point of making money to eventually spend it?
Wow.
I mean, if wealth is entirely invisible, what's the point of having it? Are we just supposed to drive the 10-year-old Toyota until we die so our bank account looks like a high score in a video game?
That is the exact friction everyone faces, and it's a very, very valid challenge.
It's so.
It cuts to the absolute core of how consumer culture defines success. But you have to look at the hidden costs of those peacock feathers.
What's the cost?
The cost of visible status is your freedom.
Oh.
True wealth, invisible wealth, is a state of financial freedom. It is unspent capital sitting quietly in accounts, generating more capital.
So the psychology of staying wealthy requires you to value that invisible safety net more than the visible validation of strangers at a stoplight.
Exactly. It requires that paranoia we mentioned earlier, knowing the economy could crash, your industry could pivot, your health could fail.
So that invisible wealth is your armor against a chaotic world.
It's your armor, yes.
But it is so incredibly hard to actually practice. And I really want to acknowledge that for you listening right now. Society is hardwired to only reward visible consumption.
Oh, totally.
If you buy a Rolex, people compliment you. If you buy a massive house, people come to your housewarming party, they bring you expensive wine, and they congratulate you.
But there are zero visual cues for a fully funded retirement account.
Zero. Nobody throws you a parade when you max out your IRA.
Nobody gives you a thumbs up in the grocery store for having zero credit card debt.
Right. So it makes it incredibly difficult psychologically to emulate true wealth because you literally cannot see it.
It requires a profound, honestly painful rewiring of what gives you a dopamine hit.
You have to change what makes you feel good.
Yeah. You have to transition from getting a rush of pleasure out of the purchase, out of the swipe of the credit card, to getting a deep sense of pleasure and peace out of the security.
You have to learn to look at your bank statement and feel the exact same thrill someone else feels looking at a luxury watch on their wrist.
Exactly.
Okay, I concede the point. But if the goal isn't to buy the Lamborghini and show off, then this invisible, unspent money must serve a higher purpose.
It does.
It can't just be about hoarding for the sake of hoarding, sitting in a dark room counting gold coins like a dragon.
Right. No one wants to be smog.
What is the actual tangible utility of all this saved, invisible money?
The utility is the single most valuable, non-renewable commodity in human existence.
Which is,
It is freedom.
yes, deep down, people don't actually want bigger houses.
They don't.
They don't really want luxury watches or designer clothes. They think they do because that's what a trillion-dollar advertising industry tells them will make them happy.
But what they really crave is freedom.
The freedom to say no.
Yes.
The freedom to spend a Tuesday afternoon with their kids without having to beg a boss for permission.
The freedom to quit a toxic, soul-crushing job because they aren't chained to the next paycheck.
The freedom simply to choose how they spend their days. Money's greatest value is control over your time.
Because time is completely irreversible.
Once it's gone, it's gone.
Once an hour is gone, no amount of money, not all the billions on Wall Street, not the entire Federal Reserve, can buy it back.
Right.
Therefore, having options and having control over your schedule is the highest possible form of wealth.
Here's where it gets really interesting to me.
Okay, what is it?
If you look at it this way, money is essentially a time machine.
Ooh, a time machine. I like that.
Right. It doesn't just buy objects. It literally buys back your future hours.
Yes, exactly.
When you save $1,000, you aren't just putting arbitrary numbers in a bank database. You are buying a week in the future where you don't have to work if you don't want to.
You are purchasing your own future autonomy.
Yes.
That is the exact mindset shift required to build real wealth. And it completely changes how we should look at saving.
How so?
Well, the standard advice, the stuff we hear from every generic financial blog is pay your bills, buy what you need, have a little fun on the weekends, and then save whatever happens to be left over at the end of the month.
The pay yourself last model.
Right. The problem is human nature ensures there is almost never anything left over.
Never.
Have you ever heard of Parkinson's law?
Remind me.
It states that work expands to fill the time allotted for it. Well, it's the same with money. Spending expands to fill the income available.
So you have to flip the equation. You save like your future depends on it, because it literally does.
You spend what is left after saving, not the other way around.
But here is a concept from the material that I found incredibly refreshing and totally counter to everything we're traditionally taught.
Which part?
Usually, financial advisors tell you that you need a goal to save for.
Oh, yeah, like save for a down payment on a house.
Right. Save for a new car, save for a vacation to Italy.
Sure.
But the philosophy here argues that you don't actually need a specific reason to save. You should just save for absolutely no reason at all.
Saving for no reason is one of the most brilliant defensive strategies you can adopt.
Why do you do it then?
You save because life is fundamentally aggressively unpredictable.
The universe is chaotic.
Completely chaotic. Unexpected expenses happen, the roof leaks during a storm, the car transmission blows on the highway, a medical emergency pops up.
Things you literally couldn't have planned for.
Exactly. But equally importantly, unexpected opportunities appear.
Oh, that's a great point. Like
a chance to start a business with a friend, or a chance to take a year off and travel while you're still young, or a chance to invest in something incredible when the market dips.
And if you only save for specific, predictable things like a car or a house,
you are going to be caught completely off guard by the unpredictable chaos of the world.
savings create a buffer against that chaos. Savings create options.
Yes.
Hold on, let me inject some real-world friction here again.
Go ahead.
Telling someone to save for no reason sounds beautiful on a deep dive like this. It sounds like great philosophical advice. But right now, rent is up 20% in a lot of cities. Groceries have doubled. People are stretched to their absolute limits.
It's very true.
How does a regular person actually practice this psychology when they feel like they have zero margin for error? Doesn't this advice feel a bit tone-deaf to someone living paycheck to paycheck?
That is the hardest reality of personal finance, and it requires profound empathy to address.
Yeah.
If you are literally choosing between heating your apartment and feeding your family, this philosophy does not apply to you yet. Survival comes first.
Of course.
But for the vast majority of the middle class, the lack of margin is partially a product of lifestyle creep.
The subtle incremental increase in spending as income goes up.
Exactly. The subscriptions, the slightly nicer car, the food delivery apps.
It adds up so fast.
It does. The friction you're talking about is very real. But the way out of it is to view saving not as a punishment,
Right.
not as a restriction of your lifestyle, but as a rebellion against a system that wants you perpetually broke and dependent.
A rebellion. Wow.
Even if it is $50 a month, that $50 is a down payment on your own autonomy.
It completely changes your psychological posture.
It really does.
Let's talk about the peace that comes from this invisible wealth. Imagine waking up on a Wednesday and, with absolute certainty that if your car breaks down today or your furnace dies,
It's just a nuisance.
exactly, it's just an annoying chore to get it fixed.
Yeah.
It's a phone call to a mechanic. It is not a life-ruining financial catastrophe that will put you in credit card debt for 3 years.
That invisible wealth changes how you walk through the world.
It changes how you speak to your boss.
Oh, absolutely. Think about a person who has a year of living expenses saved up in a simple, boring bank account.
Okay.
Now compare them to someone making the exact same salary who needs Friday's paycheck just to make rent.
The difference in their stress levels must be astronomical.
Night and day. The person with savings doesn't tolerate workplace abuse.
Right.
They don't absorb toxic stress in the same way. They aren't terrified of layoffs.
Because they know they have the freedom to just stand up, clear off their desk, and walk away.
The size of your income actually matters far less than the size of your savings habit in generating that daily visceral peace.
A high income with zero savings means you are entirely dependent on the next paycheck.
Which means you have zero freedom. You are just a highly paid servant.
But a modest income with a high savings rate means you are constantly buying back your future time.
Yes.
So saving buys time and it buys freedom. But let's be honest, saving alone, just stuffing cash under the mattress or leaving it in a basic checking account where inflation eats away its purchasing power, isn't quite enough to build massive, life-changing generational wealth.
No, it's not.
To cross that bridge, we have to understand a hidden, almost magical mathematical force, as well as the completely chaotic, invisible forces of the universe. We need to talk about compounding, luck, and risk.
Let's start with the mathematical magic, compounding.
Okay.
This is the mechanism that turns modest savings into enormous wealth. Now, the standard metaphor is usually planting a seed and watching it grow into a tree.
Right, but that doesn't really explain how it works mathematically.
No, it just explains that it gets bigger.
We need to explain the mechanics of how it gets bigger so aggressively.
Right. So let's use the metaphor of a snowball rolling down a very long, snow-covered hill.
Okay, I'm picturing it.
When you start, you pack a tiny snowball in your hands. It's small, it's light, it's insignificant.
Right.
You roll it once, and it picks up a tiny bit of snow. But here is the mechanism of compounding. As the snowball gets larger, its surface area increases.
Ah.
The geometric formula for the surface area of a sphere means that with every single rotation, the larger snowball is picking up exponentially more snow than it did when it was small.
It's earning interest on its interest.
Exactly. If you invest $10,000 at an 8% return, you earn $800 the first year.
That's the first rotation of the snowball.
But the next year, you aren't earning 8% on 10,000.
You're earning 8% on 10,800.
The surface area grew. Give that process 30, 40, or 50 years, and the snowball becomes an absolute avalanche.
But it is so hard for the human brain to grasp this
It is.
because we evolved to think linearly. If we hunt one mammoth, we have one mammoth worth of meat. If we hunt two, we have two. 1 + 1 = 2. 2 + 1 = 3.
Right.
Compounding is exponential, which feels incredibly unnatural to our linear brains.
It does feel unnatural, which is why we constantly interrupt it.
We get bored.
We get bored, we pull the money out, we try to time the market. But the greatest example of uninterrupted compounding is Warren Buffett.
Okay, let's talk about Buffett. Everyone thinks of him as the ultimate financial genius.
Like an oracle who just knows how to pick the perfect stock every single time through sheer intellect.
Right. The media portrays his wealth as a product of supreme, untouchable intelligence.
But look at the actual timeline of his wealth.
Okay.
At the time of a major analysis of his net worth, he was worth roughly $84.5 billion.
$84 billion.
Do you know how much of that was accumulated after his 50th birthday?
It's a staggering percentage, isn't it?
Over $84 billion of it.
Wait, what?
Yes. Almost all of it came after he turned 50, and the vast majority came after he qualified for Social Security in his mid-60s.
That is mind-blowing.
His true superpower isn't just picking stocks. His true superpower is that he started investing when he was 10 years old, and he never stopped.
He has been rolling that exact same snowball down the exact same hill for 3/4 of a century.
Time is the greatest investor in the world.
The earlier you start, the smaller the snowball needs to be, and the less effort you need to push it.
Exactly.
But as soon as we establish this beautiful, clean mathematical rule, we have to introduce the chaos elements.
We do. Because life isn't a controlled laboratory experiment.
No, it's not. We have to talk about luck and risk.
Luck and risk are the two invisible hands that steer the global economy.
And they control far more of our individual financial outcomes than we are ever comfortable admitting.
We really hate admitting it.
We do. Success stories always sound so clean and linear in hindsight.
Oh, always.
You read an autobiography of a CEO, and it's always, I woke up at 4 a.m., I grounded out, I never gave up, I outworked everyone, and that's why I'm a billionaire.
It's the ultimate narrative fallacy. We love a hero's journey where effort directly and predictably equals reward.
Because it makes the world feel safe and controllable.
But that is only a fraction of the truth. Luck matters immensely.
And so does risk.
They are actually two sides of the exact same coin. They both represent the reality that every outcome in life is guided by forces other than individual effort.
Let's use a profound historical example to illustrate this. Let's look at Bill Gates.
Bill Gates is the perfect case study in the intersection of supreme talent, hard work, and unfathomable luck.
Walk me through it.
Okay, so in 1968, Bill Gates happened to attend Lakeside School in Seattle. At that time, Lakeside was one of the only high schools in the entire world that had a computer that students could use.
In 1968.
Yeah. The odds of a teenager having access to a computer in 1968 were roughly 1 in a million.
Wow.
If Gates had gone to literally any other school, Microsoft likely never exists. He was brilliant, he worked tirelessly, but he also experienced a 1 in a million stroke of luck.
But the dark mirror to that story is his friend, Kent Evans.
Exactly. Kent Evans was Bill Gates' best friend at Lakeside.
I've never even heard of him.
Most people haven't. But by Gates' own admission, Kent was just as smart, just as driven, and just as passionate about computers.
So they were on the same track.
They were supposed to conquer the world together. But before they graduated, Kent Evans died in a mountaineering accident.
Oh, man. That's tragic.
It is. And the odds of dying on a mountain in high school are roughly 1 in a million.
I see the parallel.
Gates experienced 1 in a million luck. Evans experienced 1 in a million risk. Same inputs, same intellect, same drive, drastically, tragically different outputs.
So two completely different people can be faced with the exact same conditions, make the exact same decisions.
And one succeeds wildly while the other fails completely.
Because there are thousands of unseen variables, a pandemic, a geopolitical shift, and an unexpected illness that are entirely out of our control.
Life just isn't fair.
No, we can never assume that successful people know everything, and we can never assume that failures know nothing.
Exactly.
But I have to inject a real sense of friction here, because I feel like this could land the wrong way.
Okay, what are you thinking?
If luck and risk are truly such dominant, overwhelming forces in our financial lives, doesn't that induce a kind of financial nihilism for the listener?
Financial nihilism.
Yeah. If I'm listening to this on my commute right now, I might think, well, why am I bothering? Why am I getting out of bed early to research an index fund or analyze a business plan or try to save my money if the invisible hand of luck is just going to steer the ship anyway?
Right.
Doesn't this just make people want to give up and buy lottery tickets?
That is a very natural defensive reaction. If we can't control it, why try?
Exactly.
But that misses the core philosophy completely. Acknowledging the role of luck is not about giving up. It is about adopting humility.
Humility.
When you succeed, realizing that luck played a part keeps your ego in check. It prevents you from thinking you are an infallible genius.
Okay, so it's a defense mechanism against our own ego.
Exactly. And that humility prevents you from taking catastrophic, overconfident risks in the future.
What about the risk side?
Conversely, acknowledging risk is about adopting caution and self-compassion. It's about realizing that not every failure is a result of stupidity or laziness or some fatal character flaw.
Sometimes you just catch a bad break.
Exactly. Sometimes you make the right decision, you do the math perfectly, and you just catch a bad break. Understanding both of these forces makes you undeniably wiser.
I love that.
And crucially, this ties perfectly back to the compounding snowball metaphor.
Wait, how does acknowledging luck tie into compounding?
Because consistency and time are the ultimate antidotes to the chaos of luck and risk.
Ooh.
Think about it. If you are relying on one big investment, one massive stock pick, or one business venture to make you rich quickly,
You are highly, dangerously dependent on luck.
you are literally flipping a coin. But if your strategy is making small, consistent investments into a broad index fund over 30 years, you are actively reducing your reliance on luck.
Because an index fund is basically the ultimate admission of humility.
Yes.
For anyone listening who isn't familiar with the term, an index fund is an investment that essentially buys a tiny slice of every single major company in the stock market.
Right.
Instead of trying to find the needle in the haystack, which requires immense luck,
Yeah.
you just buy the entire haystack.
Perfectly said. You are admitting, I am not smart enough or lucky enough to pick the one company that will win, so you buy them all.
You capture the broad, upward trajectory of human progress and innovation over time.
And the consistency of doing that decade after decade smooths out the volatility of luck. It takes the pressure completely off needing a lucky big win.
That makes total sense. It mathematically dilutes the impact of a single bad break.
It does. But this also highlights the incredible danger of idolizing extreme success stories. We suffer from massive survivorship bias.
Survivorship bias is incredibly dangerous.
We only study the risk takers who survived and won. We see the billionaire on the magazine cover, and the instinct is to study their morning routine, study their exact portfolio, and try to replicate their exact actions.
We don't write biographies about the 10,000 other people who took the exact same risks
Had the exact same morning routine.
and lost absolutely everything because they caught a bad break.
If we ignore the massive role that luck and risk played in a specific billionaire's journey, we might try to replicate a playbook that was essentially a 1-in-a-million lottery ticket.
You cannot replicate being in the right place at the right time.
No, you can't.
So, if time's the greatest investor and compounding works its magic endlessly over decades, human nature dictates that we should just let it ride forever.
Just keep spinning the wheel.
Just keep accumulating, keep growing the pile, keep spinning the wheel to get more and more and more. But that brings up a really crucial, almost philosophical wall that we eventually hit.
Which is?
How do you actually know when you have won the game? When do you step off the treadmill?
This brings us to what might be the most vital psychological tool in all of finance.
Okay.
It's a superpower, really. It's the concept of enough.
The superpower of enough.
Let's dive into this trap of just a little more.
Yeah.
Because greed destroys wealth faster than bad investments ever could.
There are so many stories of people who had everything but lost it all because they couldn't define what enough was.
The story of Rajat Gupta is one of the most chilling examples of this.
Remind me about Rajat Gupta.
So Rajat Gupta was the CEO of McKinsey, which is one of the most prestigious consulting firms in the world.
Super high-powered.
He sat on the board of directors for Goldman Sachs, and by all accounts, he was worth roughly $100 million.
$100 million.
He had unimaginable wealth, power, and prestige.
He could have lived in luxury for 1,000 lifetimes.
He had won the game completely.
But it wasn't enough.
No. He looked around the boardroom at Goldman Sachs and he saw billionaires.
Ah?
He was only a mere centimillionaire. He wanted to be a billionaire. He wanted just a little more.
So what did he do?
He engaged in insider trading. He passed confidential boardroom information to a hedge fund manager.
Wow.
He was caught, he was convicted, and he went to federal prison. His reputation was permanently destroyed.
Why? Because he had no sense of enough?
He risked money he didn't need to make money he didn't need.
It is the ultimate tragedy of unchecked accumulation. Many people never stop chasing more.
Never.
More money, more status, more cars, more square footage. The goalposts just keep moving.
So what does this all mean for us?
Well, it makes me think of running a race where the finish line keeps moving. Imagine you're training for a marathon, right?
Okay.
You run 26 miles. You can physically see the finish line banner. But just as you get within 100 yards, the race organizers drive up in a truck, pull the banner out of the ground, and move it 3 miles further down the road.
That sounds agonizing.
So you keep running.
Yeah.
And right as you get close again, they move it again.
It never ends.
Eventually, no matter how fit you are, no matter how great your endurance is, your heart will give out. You will literally collapse on the course.
Chasing wealth without a defined concept of enough is exactly like that.
You will exhaust your entire life running a race that has no end.
This raises an important question, though, perhaps the most important question in personal finance. What is your finish line?
Where do you plant the banner?
The philosophy here deeply analyzes this concept of enough, not as a compromise.
It isn't settling.
No, it isn't a limitation or a sign of weakness. It is a highly protective superpower. It is the ultimate defense mechanism against greed.
And remember what we discussed earlier, greed is the primary emotion that undoes all the beautiful compounding you've spent years building.
Knowing when to stop protects everything you have built.
Because greed destroys wealth faster than bad investments.
And it destroys more than just financial wealth. We have to look at the hierarchy of wealth, which society often gets completely backward.
How so?
Financial wealth is entirely subservient to your health, your reputation, and your relationships.
The irreplaceable assets.
Exactly. You can make a terrible investment, lose half your net worth in a market crash, and over the next 10 years of disciplined saving, you can earn it all back.
Money is replaceable.
But you cannot replace a ruined reputation, like Rajat Gupta learned. You cannot easily replace a broken family that you ignored for 20 years while you were at the office chasing a promotion you didn't even need.
And you certainly cannot replace your physical and mental health once the stress of the treadmill destroys it.
Risking the irreplaceable things in your life to gain the replaceable thing, more money, is the ultimate failure in the psychology of money.
Money without peace is poverty in disguise. I really want you, the listener, to let that sink in. Money without peace is poverty in disguise.
It's a powerful statement.
It is a direct challenge to you. We live in a world of endless comparison, fueled by algorithms that are literally designed to make you feel inadequate.
You scroll through social media and see everyone else's promotions, their European vacations, their new kitchens.
In that environment, defining your personal enough is an act of radical rebellion.
It is you saying, I am stepping off the treadmill. I refuse to play this game.
It allows you to transition from the constant, exhausting stress of accumulating to the deep, settled peace of maintaining.
It's a profound shift in your identity. You stop being a seeker of wealth, constantly looking outward for validation.
And you start being a custodian of your own freedom, looking inward for peace.
Well said.
As we start to synthesize this incredible journey through the psychology of money, the takeaways fundamentally rewrite how we should view our finances.
They really do.
Building wealth is not about outsmarting Wall Street. It's not about having a high IQ or predicting macroeconomic trends or finding the perfect crypto coin before it pops.
It is entirely 100% about mastering yourself.
It is the discipline to spend less than you earn, no matter how much your income grows.
It is the habit of saving consistently for no specific reason other than buying back your future autonomy.
It is the emotional regulation to invest patiently, letting the snowball roll down the hill for decades and ignoring the panic and the euphoria of the crowds.
And it is the wisdom to ignore unnecessary comparisons, recognizing that true wealth is the money you don't see.
The unspent options, the invisible armor.
It is valuing your personal freedom far above any visible status symbol a car dealership can sell you.
The ultimate goal here isn't to be the richest person in the room.
Because the richest person in the room might be deeply miserable, highly leveraged, and terrified of losing their status.
The goal is to construct a life where money works for you as a quiet tool, rather than you working for money as its anxious servant.
Which leaves us with one final lingering thought to really chew on.
What's that?
We spend so much of our life, our waking hours, our stress, our education, our energy obsessing over how to acquire money, how to grow it, and how to protect it from inflation and taxes.
It consumes us.
But if the ultimate goal of wealth is truly freedom and peace,
if it's really about buying back your time and avoiding the endless, exhausting trap of just a little more,
what if the truest measure of financial success isn't how much you think about your wealth or how perfectly you manage your portfolio?
What if the ultimate achievement, the true finish line, is reaching a point where you never actually have to think about money at all? Imagine that. The $50,000 a year janitor we talked about at the very beginning, the one who quietly saved, checked his ego at the door, and let compounding do its invisible magic, waking up on a Tuesday morning making coffee and never once checking the stock market. Never once worrying about a bill.
While the $500,000 executive is having a panic attack over a foreclosed mansion.
The math didn't save him. The behavior did. Until next time, keep diving deep.